Opendoor stock ended the week at $8.10 per share, up 9 cents or about 1.2% on Friday, and added another 6 cents in the aftermarket. The $8 level has emerged as a clear support zone. Each session this week has seen the stock trade around that mark and close above it. Buyers are steadily absorbing supply, and the tape shows a base forming. In technical and psychological terms, this is an important sign. A stock that holds a round number after repeated tests signals that sentiment is shifting and that the risk-reward profile is changing. Short sellers built large positions in Opendoor during a very different phase of the company's life. The old Opendoor was synonymous with an unproven iBuying model, high losses, and execution drift. It was perceived as a one-dimensional home-flipping business vulnerable to housing cycles and rising rates. Management turnover and a lack of visible innovation gave shorts confidence to lean into their bets. Many of those positions were established at much higher prices. The thesis was simple: the business model was broken, and the stock would continue to slide. Over the past several months, that backdrop has begun to change. Kaz Nejatian took over as CEO and has been reshaping the culture and the product pipeline. This week he announced a revamp of the careers page to make it clearer what Opendoor values. His words were no corpo jargon, just in-person, hard, valuable and fun work. This is not cosmetic. It signals a leaner, high-output organization built on execution and discipline rather than bureaucracy. Culture is a leading indicator of performance. A company that resets its values to attract builders, not bureaucrats, is preparing to ship. The Dallas pilot program launched earlier this week offers a 7-day home test drive and a 100-day home warranty. Former Twitter COO Adam Bain called it a solution to FOFO, fear of finding out. By tackling the biggest emotional barrier to buying a home, Opendoor positions itself as the company eliminating that fear. If the Dallas pilot succeeds, it can accelerate inventory turnover and improve unit economics. That is exactly the kind of visible, customer-obsessed innovation that undermines the old short thesis. Keith Rabois has highlighted Opendoor's partnership with Rome, a startup focused on assumable mortgages. He pointed out that the company has had this partnership for over a year and that many great projects never launched under the old company. In a high-rate environment, the ability to assume a seller's mortgage is a major advantage for buyers. If Opendoor can integrate that capability into its platform, it becomes much more than a home flipping operation. It becomes a one-stop shop for ownership, find, test, finance and move in. That's a model with a larger addressable market and stronger defensibility. Kaz Nejatian has also been hinting at upcoming changes. He posted about a sleep pod arriving at the office and wrote that a relatively big change has already shipped internally. Users will not notice it for a week or two, but feature flags are turning on soon. This language signals rapid execution and a pipeline of improvements that will show up in user experience and metrics over time. Founder-level hires are joining the company, including 2 XY Combinator founders and Fodder Nunter, a veteran of Shopify and Snapchat, who has said that working at Opendoor is the most exciting and potentially most impactful work of his career. This kind of talent does not join a stagnating company. All of these developments build a picture of a company consolidating its stock above a key level while building momentum behind the scenes. The Dallas pilot addresses buyer fear, the Rome partnership hints at a deeper financing play, the CEO is signaling big changes, founder-level hires are arriving and a top recruit is calling it the most exciting work of his career. Leadership has also responded strongly to criticism from a Wall Street Journal article that portrayed Opendoor's rise as hype. Eric Jackson, Kaz Nejatian, and Keith Rabois each pushed back publicly, pointing out the lack of balance in the article and signaling confidence in the company's future. For short sellers, this combination of steady price action, product innovation, cultural reset and unified leadership rebuttal changes the risk profile. Shorts rely on deterioration or stagnation. They hate inflection points. When a company ships visible products, hints at bigger changes and attracts top talent while insiders are publicly confident, the risk of a positive surprise grows. A strong product announcement or earnings beat can flip sentiment quickly and force covering. That's how squeezes develop. They don't start with hype, they start with quiet accumulation and a changing narrative. The $8 level now represents more than just a number on a chart. It reflects a growing conviction that Opendoor is no longer the company it was when many short positions were opened. Under Kaz Nejatian, the focus has shifted to hard, valuable, fun work done in person. The Dallas FOFO program is live. Financing tools like Rome are in the wings. Feature flags for a relatively big change are turning on soon. Top-tier talent is coming in, not leaving. And leadership is publicly confident enough to rebut negative press head-on. Culture is a leading indicator of stock performance. Companies such as Shopify, Tesla, and Palantir went through similar phases, dismissed as hype while they were actually building strong cultures and pipelines of innovation. Over time, those factors showed up in metrics and then in massive stock moves. Shorts and skeptics often miss this because they focus on trailing numbers rather than leading indicators. Opendoor is showing many of the same early signs. A clear culture, founder-led intensity, a pipeline of customer-focused innovation, and a base forming in the stock price are the conditions that precede re-ratings. If Opendoor proves that its new programs work, integrates financing tools, maintains its cultural reset, and continues to attract top-tier talent, the stock could move well beyond the current base. The combination of FOFO initiatives, Rome integration, founder-level hiring, and unified pushback against negative press creates a backdrop that often precedes a re-rating if execution continues. Shorts who have been comfortable betting against the company may find themselves under pressure to cover. As the company moves forward, the key factors to watch are whether the $8 level continues to hold, how the Dallas pilot performs, any official announcements about new products or partnerships, and when the relatively big change Kaz teased becomes visible to users. Each of these events can act as a trigger for a narrative re-rating. The quiet signals being sent now may be the foundations of a turnaround story. This weekend provides a moment to see the bigger picture. A company is quietly reshaping itself. Culture, hiring, product innovation, and leadership confidence are aligning. Buyers are supporting the stock even without fresh headlines. These are the conditions under which sentiment can shift and shorts can feel pressure to cover. Opendoor has the opportunity to turn its culture reset into tangible results. If it succeeds, the stock may no longer be viewed as a loss-making iBuyer but as a platform reshaping how homes are bought and sold. For investors who understand that culture and execution lead fundamentals, this period of quiet base building above $8 could be the setup for the next move. Shorts who built positions under a different CEO and strategy now face a changed risk profile. The script may soon flip.